Kurt Nye, MAI's Chief Investment Officer, and on this edition of Talking Shop, I'm joined by Chris Grisanti, MAI's Chief Market Strategist, Nick Srmag, MAI's Head of Fixed Income, and Ben Sayer, MAI's Head of Alternative Investments. Ben, let's dive right into private markets. To gauge what's going on right now, because there is a lot of volatility and uncertainty, I think it's very interesting and informative that your team started to have a number of conversations with existing partners and potential new partners in private markets. Can you tell us some takeaways from those conversations?
Happy to, Kurt. It was really great to get a boots on the ground perspective from all of our partners on how they're assessing the impact of those tariffs and how that's directly impacting their portfolios. And so one emergent theme that came through from all of these calls was that all of our partners are really looking at this from three lenses. First and foremost, they're trying to assess the direct impacts that tariffs are having on companies that directly import things from overseas, and how those companies are handling that by either trying to find other suppliers with less tariff impact or trying to pass on those prices to their customers. The second order impact of tariffs is businesses that maybe don't directly import things themselves, but buy things from people that do. And so they're trying to negotiate with their suppliers on shore to see what their impact and what their strategy is going to be and assess how that'll impact their business. And then the third order impact, where no one really wants to take draw a line in the sand yet or make any sort of forecasts, is on the macroeconomic impact of all of this uncertainty. And so when you've got suppliers that are coming from overseas, not knowing what prices are going to be, maybe taking a pause or trying to hurry up and import a lot, then you've got the second order impact of that. And all of this uncertainty causing either delays in business negotiations or business agreements or even sales in general. And then that relates back to CapEx in their business or making investment decisions that are also being put on hold. And then even hiring decisions that are being put on hold due to all of this. I think people think and fear that could create a slowdown in the broader economy, and no one's ready to really draw a line in the sand and say, hey, this business is completely isolated from tariffs or even first or second order impacts of tariffs, but it could be impacted just due to the general slow nature of the economy.
So when we talk about first order, second order, started talking about third order impacts of tariffs, I think we can confidently say that the companies are taking this very seriously and devoting a number of resources to it. Maybe to jump into some of the more important asset classes within our asset allocation framework, if we dive into the income low volatility segment of alternatives, what are you seeing in terms of the evolution of credit risk there?
Yeah. And to your earlier point, Kurt, the number of times I heard a business has a tariff war room set up was astonishing, but also good that everyone's taking this very seriously. But moving on to the income low vol segment, what we saw in private credit basically immediately after Liberation Day was the broadly syndicated loan market really grinded to a halt.
Let me interrupt you here. We hear broadly syndicated loans. I'm sure people are going to question, well, what are broadly syndicated loans used for, and why do I care?
Yes. And so when we talk about private credit, just in generally, there's two flavors. So you've got sponsored backed finance, which is basically a private equity sponsor buys a company and they're going to borrow a portion of that purchase price from the credit markets. And they can either go to a private credit shop to directly negotiate with one firm, or if the company's big enough, they can go to a number of banks, and a lead bank will say, we'll lead the underwriting, but then we'll syndicate this loan across a number of other banks. And so that's what we're talking about when we're talking about the broadly syndicated loan market.
So Chris and I want to go purchase a business. We don't have enough cash to buy the whole thing. Assuming it's a business of sufficient size and scale, we could tap the broadly syndicated loan market for some debt.
Exactly. And so those stats that come out of the broadly syndicated loan market are much more real time than those of private credit shops that may only issue quarterly reports to their LPs, and those quarterly reports may not even be public. And so when we look to assess the impacts of private credit, it's very useful to look at what's happening in the broadly syndicated loan market as a guide to what's happening across the rest of the industry.
Great. Let's jump from private credit. I know you looked at private equity. My guess is that if private credit is slowed down significantly, you'd see a commensurate slowdown in private equity. If that's not true, let's dive into it. But maybe on the other hand, we could talk about some of the opportunities that you're seeing right now and in ways to play offense in more of a risk managed approach.
Exactly. And so your point about private equity is absolutely correct. If these sponsors can't get credit to fund some of their purchases, they're just not going to transact. And so we expect to see a broader slowdown in private equity commensurate with that slowdown in credit markets. But moving to the opportunity set, right now, I think I would say, excited to deploy capital are things where we can move up in quality with either the partners we're partnering with or with the assets that are going to generate the end cash flows that we receive as investors. And so there's two areas that I want to highlight that we think are opportunities right now. One is triple net lease real estate with high quality and high credit tenants. And so these are businesses that are leasing properties that are mission critical to their businesses. The rents that they're paying on those properties are just a smaller portion of the outlays of their business. And so even if they do see some macroeconomic impacts, we believe that we'll be fully able to service those rent payments. And so we think that's an attractive way to get highly contractual rent payments from high quality partners and generate really good risk adjusted returns in that respect. And so I would say overall, triple net lease real estate is something we're excited to deploy dollars into right now. And then the other one is in the infrastructure sector. And so if you think about what infrastructure is, it's basically any asset that makes your community or your city tick. And so if you think about, utilities that are delivering gas or delivering electricity to your house or to businesses in the area, if you think about transportation assets, so toll roads and airports, things that, people are still going to travel, people are still going to ship things via semis. So those things will still be used. And then digital infrastructure. So you've got, data centers and cell towers. I think even if we're in the middle of a recession, people are still going to watch Netflix either on their phone or on their TV at home and use the internet. And so when you think about the cash flows associated with those assets, some of them obviously may be impacted by this tariff noise. Like there are certain toll roads in Texas that are, very highly used by importing car parts from Mexico and delivering them to the suppliers and the manufacturers in the United States. Some of those volumes may dip, but if we're in a broadly diversified portfolio of infrastructure assets, we think most of the cash flows generated from those will be muted from broad swings in the macro economy, and that those will be good investments to make currently. And so these may not be the highest returning assets out there, but we think from a risk adjusted perspective, these are quality investments to make in client portfolios today.
That makes sense. And I know, like in prior downturns, the team is looking at so many different opportunities that if there is a market dislocation, we will do as much as possible to try to position ourselves to take advantage of that. That's a great summary of what's going on in private markets, Ben. Thank you for that. Let's move over to fixed income, which has traditionally been the sleep at night portion of the portfolio. Nick, what have you been seeing so far in the bond market?
Yeah, thanks, Kurt. Well, not surprisingly, it's really been all about the potential impacts of tariffs on bond yields and credit spreads, and trying to figure out what the Fed's reaction function to that will be. And one of the things that we know tariffs do is it makes the Fed's job more difficult because they have to contend with the potential for lower near-term growth, but higher inflation. And because Treasury yields are effectively a function of growth and inflation expectations, when you have significant uncertainty around those things, you get the elevated big swings in yields like we've experienced over the past few weeks. And as a result, Treasury yields lately, they really haven't been that great counterbalance to stocks that we've come to expect in risk-off environments.
So when I think about that from a portfolio impact, then what I'm hearing is that what has traditionally been the ballast of the portfolio, or maybe the shock absorber during times of stress, is now dealing with a dynamic that feels maybe a little bit different on that kind of treasury fixed income. So maybe the shorter term stuff has worked. Have you seen interest rate volatility show up in credit markets yet? We heard from Ben talking about in private credit origination volume being down. We heard about spreads or the amount of compensation people want in exchange for that credit risk starting to go up. But what are you seeing?
Yeah, just as Ben mentioned, we did see spreads start to widen out and credit risk start to increase as tariffs were announced, but we've gotten a bit of a reprieve lately with some of the postponements. But just thinking about this credit cycle more broadly, if you think back to 2022, we had some hard landing concerns and some banking issues in 23, but overall, this credit cycle has been relatively benign for the most part. So you really have to go back to COVID to see the last time that we experienced some significant uncertainty in credit markets. And we feel that tariffs do have the potential to create some dislocation in credit, although I think most of the pain is likely to be really relegated to the lower rated section of the high yield market, which is not a place that we've historically had significant allocations to, but worth watching nonetheless.
Nick, this might be a good time to just kind of reinforce kind of your investment philosophy in terms of fixed income. When you think about protecting against these risks, how are you doing that?
Yeah, in terms of protecting against the risks, we're really focused on high quality investment grade companies and municipalities that really have demonstrated the ability and willingness to service their debt over multiple economic cycles. And so we feel that these types of issuers and credits, really because of the scale they have and their expertise and experience, really have the ability to weather the impacts of any tariffs and any other policies that may come out.
So when you think about the levers that are available for you to pull within a fixed income portfolio, how are you using the current environment to position fixed income, and is it creating any opportunities?
Yeah, I would say as this cycle's progressed and aged, we actually took advantage of low spreads to get more defensive within fixed income. And so we moved up in credit quality. We favored investment grade bonds over high yield. And that approach has really helped us to start off the year here. In terms of opportunities, I would say we're in more of a wait and see mode at the moment, just waiting to see what the ultimate impacts of tariffs are. And I'd say if we did see some significant credit dislocation, that might provide an opportunity to add some risk exposure to portfolios. But for the time being, we're maintaining a defensive posture, just given uncertainty around policy and tariffs, but also the fact that credit spreads right now, they're still a bit rich relative to history. So we're going to be patient and really just wait for more clarity in the market or better valuations before getting more constructive in credit.
That makes sense. And I think one of the advantages of having strong fixed income, alternative, and equity committees is that ability to look across the investable universe to try to source the best possible opportunities. And so that could sometimes mean things like triple net lease real estate as a way to play increasing credit spreads, while as in an alternative to going to the bonds directly. Given recent movements in interest rates, do you have any comments on that volatility?
Yeah, I would just say, with the movements in rates, we've also seen bond prices fluctuating quite a bit. But to that point, we still view bonds as being a very important piece to a broader asset allocation. And really, given their defined principal and income streams, we view them as creating predictable outcomes for investors and also adding a level of stability to portfolios when markets are volatile like they have been recently.
And it's probably an important reminder to the audience that bond prices move inverse to the yield. So when you think about yields moving higher, that means bond prices move lower, and vice versa. Well, thank you for that, Nick. Fixed income is an important part of a diversified portfolio. We appreciate the insights. Chris, you've been managing over multiple market cycles. You've seen a number of different macroeconomic environments, different regimes in terms of trade and who's in charge of the government. Put this in perspective for us, please.
Sure, Kurt. Well, this is really a unique time. So you hate when your investment manager says that, because that means he or she is facing something that they've never seen before. But that's actually happened a lot over the last 25 years, whether it's the dot-com bubble bursting or the great financial crisis or the pandemic. Those were all unique events also. I have to say, right now, I've never seen as big a disconnect between what's happening in the market now, with it strongly rebounding from its April lows, to what might be happening several months from now. First quarter earnings have basically come in already. And in fact, they've come in a lot better than investors expected. Stocks have bounced hard, as I mentioned. And the market, I think, is flirting at least with its highs at the beginning of April. So that's a weird thing, because we have all this bad tariff news, yet stocks are back to where they were before we started getting that news. I do not want to be an alarmist, and there is absolutely no reason to head for the hills or hoard your cash. But at the end of the day, I do think that stocks reflect the earnings of the individual companies. And I think those earnings will start to slow in the summer and as we go into the fall because of tariffs. And let me talk about that in two different ways. First, there's the absolute effect of the tariffs themselves, whether it's 10% on the UK or 25% for Europe or God forbid, 150% for China, which, by the way, such a high tariff on China really just means a trade embargo. So you're not going to get anything if you have to pay almost 3 times as much for it. So that's a problem. So that's just math. So you do the math there. But that's not really the insidious short-term problem of the tariff regime. The real problem is businesses don't know what to do. So let's say you're a manufacturer that makes goods out of things that you import from other countries, or you're a retailer like Walmart that sells things that are made in Vietnam or India. So the problem is you don't know what the tariffs are going to be. You can't model for it. You don't know whether you should build a factory at home or whether you should hire people to staff that factory. So your hiring plans, your building plans, they're all on hold. So that's what I'm more afraid of in the short term, is not the absolute math of the tariffs, but this what I would call this paralysis of the business cycle, and that can pretty quickly lead to a slowdown.
Very self-reinforcing, it sounds
Right.
like, where if I know that you have some uncertainty and I have uncertainty, then I react and maybe change my hiring or investment plans.
That's true. And one of the things I want to point out is it's starting. So we have a chart here that shows the container departures from China, and they're down sharply. And this is for April, and I suspect the May numbers will look quite a bit worse. So this has not shown up in the earnings numbers yet. Obviously, companies are selling out of their current inventory, and the way accounting works is that math will look good until it doesn't. So I don't know how this will play out, but it does lead me to become more defensive. So I do think this is a time for playing defense and not offense. I usually, as a value investor by training, I usually love to be greedy when others are fearful and buy the dips. Right now, there's too much uncertainty for me to buy the dips because I can't do the math, because I can't project with any confidence the earnings of the companies who are dipping right now.
And tell me what you think about this. I mean, we're used to dealing with financial data that contains a lot of noise. So we have these very kind of volatile data series, and we're trying to put essentially the puzzle together to help us make informed investment decisions. In the current environment, we have a combination of potential pull forward in demand, where we saw things like very high volumes of autos being sold, and that could very well drop off as opposed to the tariffs. And then a lot of uncertainty around response to tariff policy, short term and long term, as well as the where the tariffs actually land. Are you seeing companies respond to that in their guidance?
I sure am, Kurt. So, of course, the biggest thing you're seeing right now is companies being less sure. And the most dramatic moves, and we've seen a lot of this, is that are the companies just pulling their guidance. So, Ford and United Airlines and lots of pretty economically sensitive companies are saying, hey, what we thought we were going to earn for 2025, we just don't know yet. They're not saying we're not. They're just saying it's just the crystal ball is too cloudy right now. We can't make reliable projections. So obviously that gives us a bit of uncertainty. And again, it has me head scratching about why the market has returned to pre-tariff announcement levels. I do want to make one final point on interest rates. There's a lot. Part of the administration's theme is, well, if the Fed would only lower interest rates, we could, muscle through this tariff difficulty. I think that's a bit deceptive, because what I think is the Fed is watching out for inflation. Tariffs can cause inflation, at least in the short term, so they're on hold. The Fed will lower rates if it sees material economic disruption. And we don't want to see that as equity holders. That's not a good thing. So, ironically, investors ought to hope that the Fed doesn't lower rates, because if they do, that's a sign that things are heading south. So that would worry me if the Fed stepped up and felt like they had to lower rates.
A case of be careful what you wish for,
Exactly.
if you will. So to that point, are there certain more high frequency or shorter term data series that you have your eyes on?
Sure.
Where you're looking at this as kind of the early warning signals, or potentially the early all clear signals?
Sure. Oh, good point. And there are a couple of reasons to be optimistic, and I'll get to those. But on the data series, what I'm really obsessed about right now, and it comes out weekly, which is handy, are the weekly unemployment claims. These are people that just lost their jobs and have filed for what we call initial unemployment claims. So they come out on Thursday mornings. Those have started to trend upwards. Another thing I look at is credit cards 90 days past due. Those have also crept upward and now are at levels that we haven't seen since the end of the pandemic. So those are kind of the canaries in the coal mine. We're starting to see them, but they're not totally convincing yet. But as I mentioned, there are just two reasons to be optimistic, and I really do want to end with that. First, unlike the pandemic or the global financial crisis, tariffs are self-induced. So we can unwind them if things get too bad. And I'd frankly argue that's the reason the market has come back, because the administration announced the 90-day pause, because they made an exemption for autos or for iPhones. So it's kind of ironic in that the tariffs caused it, and the lifting of tariffs have caused the market to snap back. So clearly, tariffs are the culprit here, and that's what the world is focused on. And I'm not saying that years from now this might not come out great and we may have more employment here, but it's just a very disruptive thing to break up 80 years of trade policy. But there's a second reason to be optimistic, which is even if we do slow down and even have a recession, if I can use the R word, these are normal parts of the business cycle. And in fact, especially for us value investors, recessions present investment opportunities that can really flourish over the next half decade. So I've managed through 6 recessions in my career, and we've always come out the other side. And I would emphasize 3 things: diversification of the portfolio, which you've mentioned, Kurt, hard research, and the patience to not either panic or to throw all your money in because you think it's at the bottom. It really has to be a very deliberate investment process.
Thank you for joining us today on Talking Shop. If you have any questions, comments, or suggestions for future episodes, please reach out to your advisor and let us know. We stand ready to help you in your investment journey.